Let's make a pit stop really quick with mortgage rates. We're talking about, new home sales. We're talking about inventory being paltry, but we have to talk about rates. That is our business. That's what we do. I want to spend a couple minutes here, guys. There's a lot to talk about, but I want to try to distill it to a couple main points. But I want to defer to you guys first. What are some of your takeaways from this conversation that HousingWire put out? Where are mortgage rates headed?
So last week, the 30-year fixed rate was at 7.29% according to HousingWire, and that's the highest it's been in decades. Now, a lot of this article, and I got the vibe from it, is 8% is on the loom, and everybody repeated it and said it in their own format or way. And but they did say that as soon as it hits 8%, we could see a retraction, and it tests the ranges between 7 to 8%, and that's more or less what will probably be for the rest of the year, which is I'm pretty confident along what I feel is going to happen as well.
Absolutely, this is everything's based on the market data. And economists already predicted rates are going to remain high and are possibly going to go higher. Mm-hmm. And that was also reaffirmed by the Fed, the Federal Reserve, and Uncle Pal. I like to say Uncle Pal because then we got Uncle Sam. They always just,
come and take some more.
Yeah. So he already said that. So rates are going to go increase. They're going to increase. And they already said they're going to put that until they actually level off inflation here. It's going back to that scary story that you shared last week, Brian.
Which one?
The scary one. You forgot the scary story where the Fed's just going to pretty much kill off the
yeah, and that's still the same thing. They got to kill the bad guy and just make sure that he's still dead. And that's similar to what Jerome Powell still said. I didn't remember that. I try to forget scary stories.
yeah. Your boogeyman hatchet murder killer analogy last week.
They're going to figure out how to kill it.
Yeah.
It's not
just
coming
keeps
back.
Coming back. Yeah, keeps coming back to life.
And not until they bring unemployment down, which is something that they mentioned again, that the numbers are still there. People are still having jobs, and until we see more softening in the labor market, or monetary policy is going to remain tight.
Yeah, I think there's a couple things happen. Well, we know there's a couple things happening. I wrote this myself. Psychological market threshold. That's what we're approaching. We're approaching this 8% number. I think they're teasing that number out a little bit to prepare people that we're going to touch and flirt with that. A lot of that has to do with the 10-year yield. I'm not going to go down that rabbit hole and explain all that on the show. That's what we have Monday Mortgage Minute for. Mm-hmm. But this is where we're going to reach a threshold where people are going to go, hold on, we've seen enough. It's too tight. It's been too long. But they're going to have to continue holding, and they're forecasting this. This is their version of letting us know that they are going to have to hold and stay here for a while, and here's why. At the end of 2022, economists forecasted rates would be roughly 5.5% by this point. We are dramatically beyond that. And to return to 5.5 would cause a couple of problems. Number one, that means something else in the economy is broken, and we have to go back to 5.5%. Number two, that means that you're going to have a resurgence of buyers, which then would inflate prices again and put even more problems on the market. And that does not necessarily mean that more existing homes would hit the market because, again, people are still comfortable at 3. So it's like a calamity of issues. And I think they're just part preparing us for this 8% level. But that the scarcity along with this is going to give them a situation where they can hold this pattern for just long enough to give themselves a chance to get back to 2% inflation.
When was the last time we saw these type of rates?
Early 2000s.
Early 2000s. And then I read in the article that it says these types of rates spurred house prices to start coming down. But right now, the biggest obstacle is that there is no inventory. So, in a regular market, higher rates do bring home prices down. But they're stating right here that home prices aren't going to be, budging or even going down drastically, but could hold their price or significantly continue to rise, as we're starting to see. And we continue to see.
In a traditional ebb and flow, that is absolutely correct. I mean, but home prices, I don't think are going to come down unless people can actually are unable to afford. But there's just like the resiliency factor that keeps happening where there is affordability among higher upper echelon earners or combined income households and all that, where it's still continuing. So that means that we should assume then that the price stabilization or mild increases will continue as well.
And I love how, other people said, when I first bought my home, when I did, it was 8.75.
Right.
But the purchase price was $242.
That's right.
Right? So I've been in this industry 17 years now. I can't believe I'm giving out my age here, but 17 years to hear a payment of $6,000, like I used earlier, $6,000, what was that? $6,035 with 20% down. Most of my clients that I work with don't have that 20% down. You know, so you're seeing $6,035. That's a lot of money.
Paying yearly salaries.
Yeah.
You know what I mean?
Yeah.
So it's very different.
And
Very different.
I'll tell you right now, I think my patience as a professional is wearing thin with these references to, oh, well, relatively historically speaking, 7 and 8% is still really low.
Yeah.
That's fine, but you have to go all the way back to the early 80s to say that, which now for most people is not true for them. You have to be talking to people in their 60s and 70s who bought their first house 40 years ago where 7 is low to them. So the amount of people that applies to is very low and narrow. And I'm honestly, I'm losing my patience a little bit with that explanation because you're talking about people for the last 15, 20 years that are not used to 7.
No.
Even 5.5, it seemed high for a long time. And we've been in this economy where everyone's used to this low rates, low cost, ease of money, access, affordability. We're getting more people in homes. Percentages of home ownership was going up for a long time, and then it flattened out, and then it's even depleting now.
Yeah.
Like this is an actual problem, and referencing those 40-year time frames is not helpful.
Yeah, I mean, hey, I was when I first bought my home, I was stressing out the payment was going to be, I was with Tanya, like, how are we going to do that payment? One way or another, we'll figure it out, I did the dollar menu at Jack in the Box, and hey, I make no money off of that, but but yeah, I stuck to Jack in the Box and the dollar menu at McDonald's, for a while, and then all of a sudden I was able to make that $2,400 payment. My world adjusted.
Yeah.
So true experience. This is where we're going at. Seeing a $6,000 and change. The average right now I see payments is $5,500 to $6,500 of a mortgage payment.
About right.
Yeah, and we'll see who that is sustainable for. We'll see who that is unsustainable for. Yeah, this is a byproduct of obviously a lot of actions, but this is also what is going to this is going to be on the record of the current Fed. They're going to have to be called to account for this because they're even things like these typical concerns we're talking about mean that rate hikes are higher for the Fed's remaining meetings this year because they are not making the progress they want. When you look at PCE going from like the 5s to the 4s and their target is 2, there's lagging effects of policy change that take months to happen. I mean, we've been in a rate hike environment since March of 2022, and this is we're in September now. So now we've gone a year and a half in a continuation upward cycle of rates to now be told, okay, we're going to have to like flatline this and hold and be in a holding pattern for a while, and then we'll have to course correct later. We're not talking about month timelines now. We're talking about quarters and years. Yeah.
I mean, here the Fed is they're fighting a balancing act right now.
Oh yeah,
and like I said,
it's like a tightrope. They're walking a tightrope.
At the beginning of the year, everybody thought that people would the Fed would start to cut rates by this time, right? But we're having the different conversation, complete opposite. We're talking about a next rate hike coming up in September once they meet again. So it just goes to show you that the data and the information can be not as, accurate at the time that you hear it, and you have to let the data really come out months over months to really get an idea of how the trajectory of things are going to play out.
Correct. Yeah, combination of a lot of things.
So many.
Essentially, if I was to distill kind of this, where are we going is again straight from the article. If the economic data stays firm, then we're going to be looking at higher rates, maintained rates for longer periods of time.
Yeah.
So I think they're forecasting some behavior, and I think buyers are starting to realize that they are going to have to really confront the reality of the situation and know that it is not going to change overnight.
Yeah.
But then decide, am I in the market now or am I not? And again, talking about our winner's mentality last week. If you're a winner, you're going to win no matter what the market's doing. And I think that is really who's going to come out on top.
That's right.
Kind of like the conversation we're having early, looking at it like a long-term investment. If you have the plan and you have the the measures to be able to cover that higher payment by house hacking, getting some roommates, maybe your house has an ADU, or you're able to make money off your property. Yeah. Right now, those properties down the line, 3, 4, 5, 10 years are going to be cash cows or going to be an investment that you said, dude, I wish I would have made that purchase back in 2023 when everybody was going crazy, but I said I have a long-term commitment to this and I see the way out.
I mean, that's a great point, Brian. We're talking about here around the corner, a 2-bedroom, 2-bath is renting for $3,400 to $3,800.
Yeah.
I'll go get a 3-bedroom that has the potential of me utilizing the ADU rules that we have in California, that we can make the 2-car garage into a junior ADU. Exactly. Rent that thing out and many of my clients are doing it right now. I've actually personally been doing it for my properties. Rent the thing out for like $200 to $2,200. Yeah. So that kind of offsets that. And how expensive is it to convert a garage? I mean, you're talking about $55,000 to $75,000.
And then once you bring that payment down, does your payment go up? No, you could actually bring the rents up.
Exactly.
Yeah.
And then now, are you making more money, or is
Correct.
your investment now actually, cash flowing and giving you a better return?
Yeah, and we're talking when we bring them down, when the rates go down
Yeah.
and you refinance, you put yourself in a better situation.
100%.
Absolutely. So, everything is like, people tell me, should I buy now? Listen, it's like the stock market. It's not timing of the market. It's time in the market. And longevity, if you're telling me I'm looking to stay in this property 2-3 years, I say maybe hold off, But if it's long term, which I think anything in San Diego right now, it should be long term, you'll be A-OK. 2 thumbs up.
Well, guys, let's go
What does
to,
what does Lonesome Mike say about that?
Well, you guys covered a lot, so what exactly are you do you want to know?
He says, move on to the next subject.
Would you give us?
To be honest, though, when you guys were talking about it, like, it's crazy just some of the things you brought up. Like, for example, Andy brought up how he's frustrated as a professional, referencing these late averages. Because, for example, let's say people in me and Brian's age group, I mean, Brian's a few years older than me, but similar age group, you hear that stuff and you can't help but kind of look at them like, well, great, but what does it have to do with me? It has nothing to do with me. It's irrelevant.
You're like, I don't even make that much money.
Yeah, well, and the timing element
Yeah,
doesn't
yeah,
make
yeah.
any sense. Like, where were you in 1982? Like, you weren't here, so.
Hold on. I
the
was trying
answer.
to remember.
Yeah.
I can't, Andy. I wasn't here.
No, but
Shoot.
that's a good point, Mikey, because there's a
Yeah.
lot of people that are like watching this and they are your age, right? They are in that like early 20s, mid 20s, or maybe even their early 30s, and they're like, yeah, 1982 to 1987 wasn't even like, that's not a thing for me. I read about that stuff in history books.
Yeah, and just to go back to both Will and Brian saying you expect rates to go to 8%, I think the same thing too, but I guess if you really wanted to break it down and ask for like some evidence on it, they were saying if the 10-year bond yield closes above anywhere between 4.34, it could go to 8%, and it just closed right under that recently. So I mean, if you want to keep an eye on that, do what you want with that information.
And those are levels we've seen around the 2008 financial crisis.
Yeah.
Yep.
So
Same
very,
thing.
very something close to pay attention to.
And
Yeah.
that's why that really tight bond between the 10-year yield and mortgage rates as forecasters of one another is made, and it's been historically like that for a long time.
Okay. So Lonesome Mike already getting it
Yeah.
down. Look, he's the youngest mortgage hero.
That's right.
I like that.
I
Good
just,
information. 2 thumbs up,
I
Mikey.
just
On
need a
that.
new chair.